Hello there. My name's Miles Pitcher. I'm the owner of Superior Lending. I've been in the business for over 25 years now. I am excited to share with you a loan product that not a lot of people have heard about. It may not be a fit for everyone, but I love sharing it and making sure everybody knows about this. It's very, very, very cool. So let's jump into it here. So this is called the all-in-one loan. But first, before we jump into it, I want you to think a little bit about a 30-year mortgage. And it was created in the 30s, the Great Depression era. There's a lot of advantages to a 30-year mortgage, but there's also some flaws to them. For example, if you've had a 30-year mortgage, you know those first payments are so interest loaded, front loaded, heavy on interest that very little goes to principal. They are great for savings plans, but they are very inflexible. They're structured. So for a client that needs that, they're great. But for a client who is very disciplined, has good cash flow, the 30-year is a little restrictive in there. Interestingly enough, 50% of the total interest paid on a 30-year mortgage happens in the first 10 years. So there are some flaws with it. There are some things that this all-in-one loan can help replace and even do better. Right now, we understand there's an affordability issue, and 42% right now of a person's income is being consumed on average by the mortgage. We'd love to use this all-in-one loan to show clients how they can get out of debt faster and not be stuck in that 42% spot. So really, what are we trying to solve with this all-in-one loan? We want flexibility. For example, think about this. If you have extra money, why don't you just dump all your spare money into your current 30-year mortgage? Well, the answer is there's no liquidity. There's no ability to access those funds again without either selling the property or doing a refinance of some sort. We love flexibility with this all-in-one loan. And we also want to be able to help reduce the years of the mortgage and save our clients a ton in mortgage interest in there. So let's look at this. So back from 2018 to 2021, you could get a 3% rate on your mortgage. And if you look at this, you would be paying about double. If you made just minimum payments for full 30 years, you would, you'd have about a 22% increase in the home price with all the interest that you're paying. Okay. Now, currently, this 6.5 is a little bit higher than where we are right now. But if you look at that, it's an 82% increase in home price on a 30-year mortgage. So some of the positives are with a 30-year mortgage, you can read these are, again, the structure, the forced savings plan. Those are good. But some of the negatives are they're inefficient, interest front loaded, they're rigid, you can't take the money out, and they can be very expensive. So that brings us to the all-in-one loan. Let's work on this. Let's build a structure and walk you through this. Again, these have been around since 2005. They are used, this structure is used in many other countries, I believe New Zealand, Europe, Canada. And this was created and brought here to the US, and we've been using these since 2005. Default rate, as far as I'm aware, there has not been any defaults on this loan since 2005, and that includes going through the recession in 2008. Okay, so what we do on an all-in-one is we take the mortgage, and by the way, this can happen on a purchase or a refinance, but we take the mortgage and we replace it with a first position, first lien, 30-year HELOC. These are not your normal HELOCs that you get from the bank in second position right now. These are 30-year HELOCs. Okay. As you put money into the HELOC or the first position, it pays down the principal balance, leaving you equity available. And then you can pull the money out whenever you need to over 30 years. So, very simple. We have a HELOC in first position, but that's not all that comes with it. We pair this with some very powerful tools that help us out here. What we do is it's called a zero balance sweep checking account. So we have a checking account, we have the HELOC, and they're tied together in between with this sweep, which means every night at midnight, whatever is in that checking account, as far as deposits, sweeps over and pays down the mortgage, reducing the mortgage, increasing your equity. The inverse is also the case. If at the end of the day, you are spending money out of that checking account, money sweeps back from the HELOC to pay and cover those bills in the checking account. And so the back and forth happens. It's called a zero balance because every night at midnight, that checking account will go to zero, either moving deposits over to reduce the HELOC or moving money from the HELOC back to checking to cover, auto payments, bill pay, debit card, things like that. By the way, this is a FDIC insured checking account. It's just like you'd have at any bank. Great customer service. They have online banking, all just the normal. Okay. So this slide here is to have you thinking about your expenses that you have. Let's take property taxes. Property taxes are not paid on a weekly or monthly basis, even though you think they're going into your current mortgage, but they're really paid out once a year. Maybe you live in a state where they're twice a year. And so that money is just sitting there. It's either not earning you any interest or it could be saving you interest. Think about that. If you kept your property tax money in something like the all-in-one, it reduces your mortgage balance down, your HELOC down, thus saving you interest. And then you can draw it out and pay your taxes when they are due. Just look at some of those expenses. So how is interest calculated on this? It is not amortized interest. It is simple interest. So we take the interest rate, we take the current balance at the end of the night, we multiply that together and divide by 365. That's how much that daily interest charge is. And so we add that up for every single day of the month that the HELOC is there. And again, the balance may change from day to day, but we total that up and that interest is due on the 21st of the next month. It is not written out in the form of a check. It is just drawn out of the HELOC by the bank. So you don't actually have to write a check. So here, this is important. This is the structures. So in a normal 30-year mortgage, it's amortized so that when you reach the end of 30 years, your loan balance is zero. We have to do something here so that our banks can get paid back because these are HELOCs and we're just dealing with the interest due on them. So what happens is your credit limit remains constant for 10 years. And then after 10 years, it starts reducing 1/240th or over the next 20 years every month. So here's a good example. It shows how the loan balance is getting paid off rapidly, and then you have available equity. Let's take an example that we have an $800,000 credit limit. And once we hit end of year 10, that credit limit is going to start reducing down $3,300 per month. Again, this is credit limit reduction, okay? So that when you reach the end of 30 years, it's going to be zero and the bank will be paid back. So a couple of highlights here. The all-in-one, there is no prepayment penalty, no balloon. It's going to give you access to the funds for 30 years. We don't have a differentiation between jumbo and conforming loan limits or FHA loan limits. We like this because you can get loans all the way up to $3 million. You can use it purchase, refis. You can use it on primary residence, second homes, investment properties. That's super, super cool. We can do condos, townhomes, multi-unit homes up. Fourplex is the biggest we can do. If you go over 4 units, over a fourplex, that's commercial. It's not residential anymore. We also have some credit score requirements. This loan, they like to have the best of the best clients. Therefore, you can see 700 minimum FICO on primary, 720 on investment properties. Here's your loan to value max, meaning if you're doing a primary home, you can do the loan all the way up to 90%. That's not ideal. Most of our clients will do 20% down, or if they're refinancing, they have at least 20% equity. Why is that? Because from that 80 to 90%, there's going to be mortgage insurance required. So if you only have 10% down, talk to me. I'll get you the numbers on what it looks like to pay that mortgage insurance. There's your investment property, 75%. DTI stands for debt to income ratios. This is mortgage nerd stuff, but that just shows what percentage of your income goes towards paying your debts, including this new all-in-one loan. We do have to have reserves that are going to be 10 to 15%. Those need to be in sourceable assets such as a retirement account, brokerage accounts, stocks that are publicly traded. Those all count for reserves. Cash value of life insurance policies also will work. Bottom line is best of the best clients, and they need to demonstrate and show that they have strong positive cash flow. So again, this is a repeat of a lot of it. We do underwrite these to Fannie Mae guidelines, but we also have all-in-one guidelines. So there's 2 sets of guidelines that we underwrite these to. And again, reserves 10 to 15%. We do have an asset depletion option, meaning if you have a large chunk of sourceable assets in a brokerage account, we can use those for income by doing an asset depletion. So the interest rate, we'll cover more of this in a minute, but we used to use the constant maturity treasury, the CMT, but now we've switched over to the standard overnight finance rate. The SOFR is what we call it. I'll show that to you in a minute. But we take the index, the SOFR index, and then we have a margin that gets added on top. So in short, what I'm saying here is this is an adjustable rate mortgage, unlike a 30-year mortgage. And I'm going to show you, here's some examples on how this really benefits. And even though it's adjustable, it can help our clients. Okay, you can pause and read this, but these are loan limits. The top ones are primary residence. You can see purchase and refinances. When it says rate and term, that means we're just paying off the current mortgage balance or replacing it. Cash out is self-explanatory, and you can see what the max amount is. Max LTV means loan to value. So under a $3 million purchase, the max they will loan to you is 70%, $3 million. So you would have to have a 30% down payment. And then you can also see over here on the side the initial advance limits, meaning if you're doing a refinance and you have the property paid off, the minimum draw amount, not credit limit, the minimum draw is $100,000 in there. Second box there is going to be your second homes. And then here's your investment property information. And then Texas has their own set of guidelines for the all-in-one loan. Reach out to me on Texas, but you can see some of the info there on Texas for their primary residence or homestead properties. So here is the information on what is the interest rate. So what you have to look up is the 30-day average SOFR rate. You can see for November 2025, it's at 4.2. We take that, we add our margin to it. So If we take the max margin of 4%, it means our all-in-one for the month of November is going to be at 8.2%. Some of you are saying, wait, Miles, that's more expensive than a 30-year mortgage. Just hold on to that, because I will show you an example here in a minute that shows you even at 8.2%, the all-in-one can in many cases be better than that 30-year mortgage. There is a lifetime cap. So if you started at 8.2, you could go, your lifetime cap would be 14.2. If there's also a floor, because you can see from this chart, the historical SOFR, especially compared to CMT and the Fed funds rate, it can drop down to where it hits that floor. When I started these all-in-ones on my own primary residence, we were at the floor. Okay. So I want to walk you through an example. So here's a client. They make $150,000 a year after taxes. They, on average, spend $105,000 a year in household expenses. They have left over $3,700 per month. Okay, this is important. We're going to help them buy a new home at $625,000. They're going to put 20% down, $500,000 loan, primary residence. We're going to compare the 30-year mortgage at 6.5% against an all-in-one. These numbers are a couple months old, so 6.5 is higher than where we currently are, but it'll work for an example. And you can see the all-in-one on this one's at 8.4. Our all-in-one's at 8.2 right now. Okay, so I'm going to give you a visual of how this all-in-one account works first, and then we're going to analyze numbers. So we're going to start with our starting loan balance of $500,000. Our client's payroll is going to deposit into that all-in-one loan heloc, sweep over and reduce it down. So you can see we have a lower new balance. When that money comes into that account, every penny that gets deposited reduces the loan balance. So if you get a $10,000 deposit, your loan balance will go down by $10,000. It's pretty awesome. 100% of the deposit goes to reducing the loan balance. Then we start moving through the month, and we have household expenses, credit card payoffs, cell phone bills, food bills, and you can see that they draw it out as they pay their bills, and we reach a new balance at the end of the month. You'll see it's lower than the very start of the month, because remember, we have $3,700 per month left over on average. That becomes our available equity, $3,700. Then we begin into a new month, and we have a deposit from the client. Well, first, let me make these notes. That $3,700 would also include what we would have been paying in a mortgage payment and our leftover money that wasn't spent on bills, expenses, etc. Now we have our second month deposit. Boom, it drops our loan balance down. Then we have our normal spending, but now we also have the interest payment due for month one. Simple interest. It comes out on the 21st of the month. We look, we have our new balance. You can see now we have a bigger chunk of equity that's available to us. We could go back and draw that if we needed to. Month three, we have another deposit. Boom, it drops down. We have our spending, plus we have our interest payment from the prior month. At the end of the month, we have an even bigger chunk of equity. You can see how that equity is growing every single month. Okay. So again, here's a reminder of our scenario, $3,700 left over. We have a very cool all-in-one simulator that will allow you to compare your current mortgage against an all-in-one, or if you're buying a new home, that new 30-year mortgage or 15-year mortgage against your all-in-one. So I want to show you the results of taking this exact example and plugging it in and following that diagram that I just showed you. Look at this. So on the left is our all-in-one results. On the right is our traditional mortgage. Look at this. We anticipate that if that client had that $3,750 left over every month, they followed exactly what was in there, they would have that mortgage paid off in 8.6 years. The 30 mortgage minimum payments, they're going to pay 1.1 million in total payments. This, the all-in-one, is going to save them $437,000 over that 30-year mortgage. That is amazing. That's why we love this simulator. It's like, let's not just guess what our numbers, our savings will be. Let's plug it in and compare it. Again, remember that interest rate on this all-in-one is higher than what the 30-year mortgage is. But by us being able to take advantage of that positive cash flow, that leftover amount from our client, we accelerate the client's payoff, and they still have a line of credit left open with 500,000 that they can draw out. Pretty amazing. Look at this. So this is a pay down table. The first column shows the months, or 8.6 years. And at 8.6 years, our all-in-one loan, these columns, loan balance, 0. If we compared that, where is the traditional mortgage at 8.6? It still would have a loan balance of $437,000. That's pretty mind-blowing to me, that one could be paid off that fast. The other one is still just sitting there, slowly moving along. Look at that, only 62,000 paid in principal. Okay. Another just view of the all-in-one here. I either get clients who use this to pay off their home fast, and then, or they use it for investment purposes. Maybe they use it to buy an investment property, take a dream vacation, cover tuition for kids, fund an emergency medical expense. How you spend the money is totally up to you. But as long as you have that available equity in there, you can draw on that at any time and do that all the way up to 30 years in there. So again, summarizing top benefits, saves you a ton in mortgage interest as long as you are a cash flow positive borrower. It's going to build your equity faster than traditional loan. My clients on general are paying off their home 6 to 7 years based on their scenario results. Again, the equity remains available to you for 30 years without having to refinance. And here's the other piece that's pretty cool, is a lot of self-employed borrowers, their businesses are not always totally perfect. There are times that they have a slowdown in business. The great thing is that all-in-one, as long as they've paid it down, they have remaining equity. It gives them the flexibility to only make that minimum interest payment. So in slower times, it's a huge help. For me personally, I'm in the mortgage business. 2022, 23 were slower years for me. So that all-in-one flexibility was awesome. And I don't know if I told you, I have an all-in-one on a primary residence, and then I also put one on an investment property. Okay. It's very, very cool. A few features just to reiterate. Again, we've mentioned whatever deposit goes in that night, 100% of that deposit reduces down the mortgage by that amount. $15,000 deposit, mortgage goes down by $15,000. You can make them in large or small, any frequency. Deposits become equity in the home, and then home equity can be withdrawn for the 30 years. Again, the interest recomputates nightly on whatever the current loan balance is. I love this concept of becoming your own bank, or the property becoming a war chest for you. For some of my clients that I've put into these all-in-one loans, it's the last loan that I do for them. And again, I make my living off of doing 30-year mortgages for people. But imagine getting this loan, getting your home paid off fast, and then being able to finance future mortgages by yourself, buying properties with your all-in-one loan, buying other investments, right? I have clients who use it to buy inventory to grow their business. works out really cool. It becomes a war chest for people. All right, here's a link. You can see that address to where my simulator is. You can hop in there, fill out your information. If you need help on filling this out or analyzing it, I'll give you my contact info then. I'm happy to help and walk you through this and see if it makes sense. But just it's very, very cool, and it's very, very good to be able to put the numbers down and see if it makes sense. So who's this right for? You can see the list there, but the key piece is cash flow positive borrowers, people who are disciplined and people who have that just that extra cash flow coming in. Um, for some of my commissioned borrowers, realtors, this is great because they may have huge months of commissions. It drops in. They may have a slow month after that, but they're living within their budget. It works great. I've had this work phenomenally for school teachers because they're on a budget. They know exactly what's left over, and this accelerates their payoffs. Here's a quote from a past client who used this. He uses it to buy inventory. All right. We'll spend a minute here on the slide. How many all-in-ones can you have? You can technically have 3. You can have one on a primary residence, one on an investment property, one on a second home. Is there a prepayment penalty? No, not at all. You can pay it off, close it, sell the home anytime you want. What makes this better than a HELOC you would get from a credit union or a bank? So, could you do the same strategy with a HELOC from a credit union? Yes, you could, but there's no auto sweep involved. And many times, banks and credit unions have serious, serious heartburn about going over 75,000, 100,000 in the HELOC loan amounts. We can go up to 3 million, which is phenomenal. Also, a couple of things. Most HELOCs right now have a draw period of either 3 or 10 years. And then the remaining life of the loan is frozen, so you can't draw anymore and you're stuck in a repayment period. Our all-in-one does not do that. Also, I'll mention during the recession of 2008, many banks and credit unions froze or reduced credit limits on HELOCs. The all-in-one loan never did that to any of our clients. What banks will I be dealing with? For you to do the all-in-one loan, our preference and the one we use the most is North Point Bank. We also can use Merchants Bank of Indiana. I do recommend that you move your accounts to them. Don't close your accounts with your favorite childhood bank or local bank you've been working with, but you do, for this to work, you need to move your accounts over there so that your deposits are dropping into the all-in-one account. How long has this been around? I did mention since 2005. Is the interest tax deductible? So I can't tell you if your CPA can tell you if you're able to use mortgage interest as a write-off. The IRS law says that any first position mortgage, and it doesn't differentiate 30-year, 15-year mortgage or an all-in-one loan, as long as it's a first position mortgage, the interest potentially can be written off. If you're taking the standard deduction, then it doesn't benefit you. But if you're itemizing, then it should benefit you. Can this be used on commercial properties? Not our product. I've heard rumors that there are commercial all-in-one loans out there. I have not found a company to do them yet. I would love to find one. Is there a minimum initial draw amount? Yes, $100,000. Any monthly or annual fees? So if you pay off your all-in-one loan and you have a zero balance on it, it stays open. There is just an annual fee. I think it's around $75 a year, and that would be the only fee. Closing costs are very similar to what a purchase or refinance typically would be. except that we don't have any escrows or prepaids, right? We don't want a lender holding your property taxes or homeowners insurance. We want those to remain in your all-in-one loan, reducing your interest so that then when they become due, you can pay them yourself. So I'll reiterate that. You have to pay your own property taxes and homeowners insurance under the all-in-one loan. Is there an origination fee? Typically there is. It will vary based on how large the initial draw amount is. Can you close in an LLC or company name? No, you cannot. You have to close in your name personally, and then you can move the property into the entity you own after you close. Is this a full document loan? Meaning, do we need pay stubs, tax returns, etc.? Yes, we do. There are some alternative ways of qualifying, such as the asset depletion. Are there reserve requirements? Yes, 10 to 15% of the credit limit. Is there a limit on number of finance properties? Yes, on investment properties. But if it's a primary residence, there is no limit. The investment property limit is 10. How does this report to my credit? So on the credit report, it'll show like a HELOC. It'll show what the credit limit is and how much is drawn. And then it'll calculate what the monthly payment is on that, the interest only. How long does it take to process? 30, 45 days is what the typical is for us. Declining income, we're not seeing this a lot right now, but if you're self-employed, and let's say in 2024, you had a really good year, but in 2025, your business slowed down. That's what we consider declining income. Chat with me if your income has gone down like that, and we'll strategize on how to best deal with that. Is this velocity or infinite banking? No, it's not. Those are different. Those are using life insurance products or credit cards to accelerate debt payoff. But some of the principles in infinite banking can be used in an all-in-one loan. Non-warrantable condos require an exception, but yeah, they can be done through this product. Okay, I wanted to touch on this real quick because a lot of my clients, and myself included, have business checking accounts, and we are self-employed. And I get money coming in my business as in rental income. And the question is often asked, can that automatically sweep over and reduce down my all-in-one loan? So the short answer is no, but let me show you here. So what I do is I create business checking accounts at North Point Bank where I have my all-in-one. I even have multiple business checkings. When I get money that comes into those accounts, I will manually transfer that to my personal checking. And your CPA bookkeeper can help you figure out, is that a loan or is that a disbursement? How do you treat that? But it handles very well in QuickBooks. So I transfer over, and then the auto sweep kicks in and moves those funds and pays down my personal HELOC. And again, if I need to send those funds back to my business at some point to buy inventory, buy a property, cover payroll, whatever it is, I can move it back from my personal all-in-one, manually transferring it back to the business checking. But I do all this within North Point Bank where I have all my accounts. I hope that can give you a visual on how the manual transfer happens between business and personal. But once it's in the personal, the auto sweep between the personal checking and the all-in-one personal, that automatically happens. Hope that helps. If you have questions or would like to learn more, here's how you can get a hold of me. You can scan that from my digital business card. This is how you can reach out to my team, either text or email or call that number. And we'd be happy to go through all this with you and answer any questions that you may have. I know I went through this fast, But I have other videos on the all-in-one loan. Check those out. Let me make this bigger for you. So yeah, check that out on the all-in-one loan. Thank you.